Welcome back to the channel, everyone. This is Grow with Tony, and I'm glad you're here. Let's talk about a problem that keeps a lot of people up at night. It's not the fear of missing out on the next Bitcoin. It's not about finding the next Tesla before it pops. It's something much more boring and much more terrifying: cash flow. We live in a world where the cost of living feels like it's on a permanent escalator going up, while traditional income sources, savings accounts, bonds, standard dividends are taking the stairs. If you rely on the S&P 500 for income, you're getting a dividend yield hovering around maybe 1.1 or 1.2%. Let's be real. If you have $1 million portfolio, that is $11,000 or $12,000 a year. That is poverty wages for being a millionaire. It doesn't make sense. So investors start hunting. They go into the jungle of the stock market looking for yield, and recently they've stumbled upon a new beast. It has a ticker symbol, SPYI, the Neos S&P 500 High Income ETF. You look at the brochure and the numbers jump off the page. A distribution yield that consistently hovers in the range of 10 to 12%. And they tell you, hey, this isn't some risky mortgage bond or a leverage trap. This is the S&P 500. It sounds like the holy grail, double-digit passive income from the safest index in the world. But my job here isn't to sell you the dream. My job is to wake you up to the reality. Because in finance, yield is never free. It is always, and I mean always, compensation for risk. The question is, do you understand what that risk is? Today, we are going deep. We are going to take SPYI apart piece by piece. We'll look at the tax nuances regarding return of capital, the specific options strategy that powers it, and exactly what happens to your money when the market crashes, or worse, when it skyrockets. Just a quick disclaimer before we dive in: I am not a financial advisor and this is not financial advice. Do your own research before making any investment decisions. Alright, let's get into the engine room. How on earth does a fund generate 12% cash when the companies inside the fund, Apple, Microsoft, Nvidia, pay less than 1%? If you ask a typical advisor, they might mumble something about covered calls and move on. But that's not enough. We need to understand the specific flavor of covered calls SPYI uses because it's distinct from the older generation of funds like QYLD or XYLD. Here is the standard way income funds work. You buy stocks and then you write a contract promising to sell those stocks if they go above a certain price. In exchange for that promise, someone pays you cash today. That cash is the premium. That premium becomes your monthly dividend. The problem with the old way, the global X way, if you want to call it that, is that they often sold at the money calls directly against their holdings. Basically, they capped their upside right at the current price. If the market went up even 1%, the fund didn't participate. The fund stayed flat and you just got your dividend. That sounds fine until the market rips higher by 20% and your fund is still sitting at the starting line. SPYI does something a bit more sophisticated. They use a strategy involving index options. Think of it like this: SPYI holds the actual stocks in the S&P 500 to mirror the index. But then to generate that income, they write or sell call options on the SPX index itself. These are cash-settled options. They aren't selling the Apple or Microsoft shares out of your portfolio. They are settling the difference in cash. Furthermore, they don't just blindly sell the ceiling. They actively manage this. Occasionally, they may also buy call options at a higher strike price. Why do they do this? It's because if the market absolutely explodes, that second option they bought helps them capture some of that massive growth. They aren't completely left behind like the older funds might be. They are trying to thread a very difficult needle, give you high monthly income, but also let you participate just a little bit if the market has a massive bull run. Now, there is another layer here that most YouTube videos gloss over, but it's critical if you are holding this in a taxable brokerage account. It's about how the IRS treats your money. Most covered call ETFs generate income that is taxed as ordinary income. That means it's taxed at your highest marginal bracket. If you're a high earner, the government could be taking 37% or more of your dividend checks. That hurts. SPYI uses something called Section 1256 contracts. I know it sounds boring, but stick with me because this saves you money. Because they use index options on the S&P 500 itself, SPX options, rather than options on an ETF like SPY, the IRS treats the income differently. It gets a 60-40 split. 60% of the income is taxed as long-term capital gains, which is a much lower rate, usually 15% or 20%. Only 40% is taxed at your high ordinary income rate. But wait, there's more nuance here. Often, a significant portion of the monthly distribution from funds like SPYI is classified as return of capital, or ROC. This isn't necessarily bad, but you need to understand it. ROC is not taxed immediately. Instead, it lowers your cost basis. So if you bought a share at $50 and got $1 of ROC, your tax basis becomes $49. You don't pay tax on that dollar today, but you will pay capital gains tax on the difference when you eventually sell the fund. It's essentially a tax deferral strategy, which is powerful, but it's not tax avoidance. This combination of Section 1256 and return of capital is a massive deal. It makes SPYI incredibly tax efficient compared to a standard bond fund or older covered call ETFs. Okay, Tony, this sounds amazing. High yield, some upside participation, tax benefits. Where is the catch? Why shouldn't I put 100% of my net worth into this? Here is the cold, hard truth. You are selling your potential to get rich. When you buy a standard S&P 500 index fund, you are buying a ticket to the future of the American economy. If AI changes the world and the market doubles in 3 years, you double your money. When you buy SPYI, you are selling that possibility. You are trading future wealth for current income. Let's look at a hypothetical bull market scenario. The S&P 500 goes up 20% in a year. SPYI might go up maybe 8% or 10% in price appreciation, plus the 10-12% dividend, so your total return is roughly similar, maybe slightly less. You might say, Tony, that's great, and it is, but in a raging bull market, you will typically underperform the raw index. And in a compounding game, underperforming by 2% or 3% a year ends up costing you hundreds of thousands of dollars over a lifetime. Now let's look at the dark side, the bear market. What happens if the S&P 500 crashes 20%? Does SPYI protect you? Sort of, but not really. SPYI owns the underlying stocks, so if the stocks crash, the fund value crashes. However, you collected that 10% dividend, so instead of being down 20%, you might only be down 10% on a total return basis. The dividend acts as a shock absorber. It softens the blow, but it does not stop the bleeding. Do not mistake this fund for a savings account. Your principal, your original investment amount, can and will go down in a recession. We have to address the concept of the yield trap. A yield trap happens when a fund pays you a high dividend, but the share price drops by the exact same amount or more over time. It's like taking money out of your right pocket and putting it into your left pocket and pretending you got richer. Many high-yield funds are guilty of this. They are essentially returning your own capital to you and calling it a dividend. This is destructive NAV erosion. Now, high distributions don't automatically mean the fund is destroying value. The key is whether the fund is generating enough income from the option premiums plus the stock dividends to cover that payout. If the market is volatile and premiums are rich, they can cover it. If the market is quiet and premiums are low, they might be dipping into your principal to pay you. So far, SPYI has managed this reasonably well because of their active strategy, but the fund is still relatively new. We haven't seen it go through a prolonged, multi-year recession yet. That is the unknown variable. You can't talk about SPYI without talking about the heavyweight champion in the room, JEPI, JP Morgan Equity Premium Income ETF. Everyone loves JEPI. It has billions of dollars in it. So why would you choose SPYI over JEPI? Here is the main difference. JEPI doesn't own the full S&P 500. It owns a basket of low volatility stocks selected by managers and creates income using equity-linked notes. It's a bit more defensive. In a crash, JEPI might hold up slightly better because it picks safer stocks. However, because JEPI picks safer stocks, it often lags behind when tech stocks go crazy. If Apple and Nvidia are dragging the market higher, JEPI often misses out. SPYI simply owns the S&P 500. It holds the tech giants. It holds the volatility. So if you believe the market is going to rip higher led by big tech, SPYI is theoretically better positioned to capture that than JEPI. Also, consider the costs. While SPYI has tax advantages, it generally comes with a higher price tag. The expense ratio for SPYI is around 0.68%, whereas JEPI sits lower at around 0.35%. You have to weigh the tax efficiency against that higher annual fee. So let's build a profile. Who should be buying this ticker? If you are 25 or 30 years old working a 9-to-5 and you don't need the cash right now, please step away from the buy button. I see so many young investors chasing yield because they want to see that monthly deposit notification. It feels good. It releases dopamine. look, I made $50 this month doing nothing. But by taking that cash now and paying taxes on it and capping your upside, you are interrupting the compounding process. You are killing the snowball before it has a chance to roll down the hill. You should be in pure growth. You should be in VOO or VTI or QQQ. You don't need income insurance yet. Now let's flip the script. You are 60, you are retired, you have a portfolio of $1 million. The market is volatile, you are terrified of having to sell shares to pay your electric bill while the market is down 20%. That is called sequence of returns risk, and it is the #1 killer of retirement plans. For you, SPYI is a godsend. It allows you to hold your position and live off the cash flow generated by the options market. You never have to sell a single share to pay your bills. You preserve your share count. Even if the market stays flat for 5 years, you are still collecting that 10–12% yield. That is financial freedom. However, retirees need to know this. While the high dividend stops you from selling shares, it does not eliminate the risk of your portfolio value dropping. If we hit a bear market, your $1 million might turn into $800,000 on paper. The income helps, but the principal is not guaranteed. We've covered a lot of ground today, so let's distill this down into the essentials before you decide what to do with your money. #1, the yield is real, but it's variable. It comes from selling options, selling insurance on the volatility of the market. High volatility means higher yield. Calm markets might mean lower yield. Don't expect the exact same payout every single month forever. #2, the tax efficiency is a major edge. The combination of Section 1256 contracts and potential return of capital generally makes SPYI more tax efficient than many competitors for taxable accounts. #3, the catch is capped upside. You will likely underperform the S&P 500 during strong bull markets. You are paying for stability and cash flow with the currency of lost future growth. #4, it is not risk-free. If the market tanks, your principal drops. This is not a bond, it is an equity fund. Investing is never about finding the perfect investment because it doesn't exist. It's about finding the tool that solves the specific problem you have right now. If your problem is, I need cash to pay my bills without selling my stocks, SPYI is a fantastic solution. If your problem is, I need to turn $10,000 into $1 million over 30 years, look elsewhere. I hope this deep dive helped you look past the flashy yield percentage and understand the machine underneath. If you got value from this breakdown, please do me a huge favor, hit that like button, subscribe to the channel, and ring the notification bell. It really helps the algorithm show this to more people who need to hear it. And I want to hear from you in the comments. Are you holding SPYI, or do you prefer JEPI? Or maybe you think this whole high yield thing is a trap? Let me know down below. And if there is another ETF or financial topic you want me to tear apart in the next video, drop it in the comments. I read them all and I'll make the video for you. But if you're just lurking and don't want to comment, that's cool too. Thanks for listening, stay smart with your money, and I'll catch you in the next one.